Inflation data is in, and overall it was 2.7%, which is actually lower than it was estimated to be. But core inflation, which the Fed watches more closely, rose by 3.1%, which was actually higher than it was estimated to be. However, markets have been very bullish, given that tariff inflation either hasn't hit or won't be hitting, with the S&P 500 jumping to near record highs and continuing to rise, and the Fed watch probability rate of a cut has increased to 99.9%. So with jobs slowing down, the market heating up, will the Fed finally be forced to cut interest rates?
To cut or not to cut? That is the question. The market seems to have made its call. Is it right? Let's ask Robert Kaplan. He's the former Dallas Fed president, vice chairman at Goldman Sachs, and he is here at Post 9. It's nice to see you.
Good to see you, sir.
I noted you avoided the incoming today in the presidential missive at Goldman Sachs. Congratulations. He wants cuts. He's made that clear. Rick Rieder sat with me not 15, 20 minutes ago and said Fed should cut. Way too restrictive. You don't sound like you're that sold.
I'd be leaning toward cutting in September if I were in my former seat.
He's speaking very cautiously, which kind of reflects how cautious the Fed itself has been, so that's kind of understandable.
The part that I'm sort of the cross currents I'm weighing, weak job market, and you've heard me say before, the headline unemployment rate masks a weaker job market than appears, and the reason unemployment's so low is just lack of supply, but hiring is down to stall speed.
And I'm not convinced the unemployment data is accurate. When people lose a job right now, they're far more likely to start doing something like DoorDash or Uber, since filing for unemployment is so much harder and so time consuming. So what you get is a bunch of independent contractors doing DoorDash, Uber, TaskRabbit, other things like that, just holding themselves above water until they could find another job. But that other job may take weeks, months, or even years to actually find. So at the same time that they're struggling and can't find a job, they're not technically considered unemployed because they are doing some sort of work.
That would move me toward wanting to cut. Also, you've got some disinflationary forces, the AI boom, big overcapacity in goods, which I think was reflected today in the CPI. Mm-hmm. You got sluggish demand, and so all that makes me lean to cut.
Why not? Why just lean? You paint a scenario in which you'd be like falling over to cut.
Here's the.
I'm glad he's pushing back a little bit, because most people think this is the perfect environment for the Fed to cut. So the fact that he's speaking so hesitantly on this, I think, is a good reason to push back.
The only thing I want to understand, and this is a sensitive topic, but I want to understand, is we're not through the setting of the tariffs. I think it's easier for businesses to process low to mid-teens, a little harder to process high teens. It's going to get divvied up among suppliers, maybe a stronger dollar, maybe some margin erosion, maybe some in pricing. I don't know how it's going to be split. And at the Fed, if you don't need to jump into that risk, we'll know a year from now how it was split. And so the weaker job market would push me to act. But if it weren't for that, I might want to be patient.
This is the only reasonable argument I've heard for actually not lowering rates. More tariffs have been announced, but also previous tariffs have continued to be delayed. And we're not seeing tariff inflation because the can keeps getting kicked down the road. And nobody really knows what's going to happen. If those tariffs go through, there will absolutely be inflation as a result of them. But there's also no guarantee that they will go through. They might either be delayed and delayed and delayed until they no longer matter and are not implemented by the next president, or a negotiation might go through and a deal might be struck between America and some other countries, and as such, those tariffs are either non-existent or much lower. We simply don't know.
Would you admit that the tariff sky is falling calls that have been out there from people, that it's going to cause this inflation, that it hasn't materialized in a meaningful way to this point?
I do agree with that, and I've been saying for quite some time, we're in a world of manufacturing and goods overcapacity. The inflation issue in the United States, and this morning confirmed it, has not been a goods issue, it's been a services issue. So yes, in that context, it makes me feel more confident that maybe after these tariffs get set, over the next year, we'll realize it's a one-time price effect, not persistent.
It sounded like the Kansas City Fed pres today was hold. I mean, how, in your environment, the one that you see, how can anybody be a firm hold? Let's not raise rates, not cut rates right now.
The argument around the table for not cutting is the job market is still, what they're being swayed by is a headline unemployment rate of 4.2. They're saying, yeah, hiring is sluggish, but we're in balance and we still are above target on inflation. My counter argument to that would be, I think the hiring market is much weaker and the job market is much weaker. You have to look more broadly than headline. But those that will counter argue are saying, we're still at full employment, you should be more patient.
Okay, so you've stated your position that you're leaning, if you were in your former seat.
I'd be inclined to cut.
Okay, what will they do? What will they do in September?
I think they will ultimately cut in September. The only thing that could derail it is if you got a surprise in the job report early September. I don't expect that. The part that may disappoint people, this, in my opinion, is not the start of a cutting cycle. It is, we'll cut in September, and then you wipe the slate clean and take another 6 weeks to assess these cross currents, make a new decision in October and a new decision, or October, November, and a new decision in December. I think the markets have gotten ahead of that and are saying it's much more likely they're going to cut 2 or 3 times. And I don't think it's as clear as that. They may wind up doing it, but they're going to have to feel their way through it.
You think
I think this is probably very likely. We have a very cautious Fed, and there's no guarantee that we're going to get multiple consecutive cuts like we got multiple consecutive increases back when inflation was really high. Especially if we see those tariffs go through, that's going to impact the decisions they're making and could change the landscape of what Fed cuts look like.
it could really be a 25 one and done for a while?
The only reason why it would be if you saw that the weakness in the job market was overstated. I don't think that's going to happen. Then they'll have to assess that for November. But is it whether it's going to be 3? I think it's more likely to be 2 than 3, for example. But I don't know, and so we're going to have to see. Now, one other comment I would make: a lot of people say, "Well, look at last fall. They cut 50 in September. I wouldn't have done the last 25 in December, but they did 100 basis points. But the difference was a year ago we were at 5.25, 5.5. We had a lot more room. In my opinion, at 4.25, 4.5, I think you can cut down to 3.25, 3.50. But I don't think there's a lot more room to cut than that. And why do I say that? I think the inflation rate's around 2.5, 2 3/4, and the real Fed funds rate, in my opinion, is 3/4. So I think you got 75 to 100 basis points of room. Whereas a year ago, I think you had.
I don't think that's entirely correct. The economy is so unpredictable right now that it's impossible to make a call on anything. He said 75 to 100 basis points of room, but that's just kind of a maybe. If inflation increases and then the Fed cuts, then we get hyperinflation. And that would be the most devastating potential outcome. We might go back to 2022 all over again, where we were seeing 9% inflation every year.
More like 175, 200 basis points of room.
Who would be the best next chair of the Fed in your mind? Because the pool's getting bigger.
I think any number of the candidates who've been talked about, the key for the next chair, they have to have strong economic views on their own 2 feet. They have to command the respect of the room. They have to be good at assembling a consensus. And I do believe they have to demonstrate they can throw in new ideas, out of the box ideas, but they have to be committed to the ethic of the Fed, which is independence from political influence and political considerations.
Well, they have, but that's your own point of view. They have to.
That is my point
because
of view.
the president and other people around him may have a different idea. They may.
So you asked my opinion.
Yeah.
So that was my opinion. My opinion is I think the country would be best served and all parties would be best served by someone who fit those characteristics.
And that I wholeheartedly agree with. The Fed has to be independent. Otherwise, every president ever would force rate cuts because it makes money really cheap to borrow. And in the short term, that's really good. The economy will absolutely bloom. But in the long term, that will cause inflation to heat up pretty significantly, which will be worse than just having left the interest rates higher in the first place. In the same way that the Fed jacked up rates under Biden and he wasn't able to do anything about it, I think they should be able to hold rates high under Trump and he shouldn't be able to do anything about it. Now, predictably, after this came out, Trump went on a Truth Social tirade demanding that Too Late Powell cut interest rates. And then he also threatened him with a lawsuit. And frankly, this is kind of difficult to defend, even if you do think that rates either should be cut or should have already been cut earlier. The sitting president of the United States of America threatening to sue governing bodies because they're making decisions that he disagrees with is a horrible precedent to set. And we have to remember that whatever political norms are established under Trump will be utilized by Democrats the next time that they win the presidency. And I think that is a horrifying prospect. However, despite all this back and forth, the market has reacted surprisingly well to all of this inflation data.
BS Managing Director and Senior Portfolio Manager, a big money guy. Well, I mean, how do you interpret that? So he's just one voting member. There are 12 on the Federal Reserve Board, and a couple of them last time around started to wave their hands and say, hold up, we think that we need a slight rate cut at the next meeting.
It is worth noting that this was the first dissent in a long time. We saw only 2 out of 12 members of the Fed board actually disagree and say that the rates should have been cut, which is still the vast minority. A dissent is notable because it's pretty rare, but it was only 2 out of 12 members.
So I think he's on an island, or maybe he has one other person on that island with him. The vast majority of those members see the handwriting on the wall. You look at that inflation print, the shelter component makes up 35% of it, and that's showing signs of moderating. So you want to get ahead of this. You want to cut rates from a position of strength, not weakness. Add to that some of the political pressure and the so-called shadow Fed that's forming. I don't think rate cuts are a matter of if. It's when. You said it, 90-some-odd% chance of a cut in September.
The market and Fed funds futures have been wrong in the past, though. And when you have a guy like Schmidt plus Powell, the Fed chair, Jay Powell, they've been very serious about, hold up, we don't want to make a mistake and cut rates, and then suddenly we start to see the follow-through of tariffs causing inflation. But, you know, it's been 6 months. Yeah. It's been 6 months, and Stephen Myron, who has just been brought on to the Federal Reserve Board by President Trump, he said this today on Fox News.
There's no evidence thus far now. We've been doing tariffs in this administration since January 20th. Remember, we started with Canada, Mexico, and China from the get-go. And there hasn't been, it's now over 6 months, and there's still no evidence of it whatsoever. So the burden of proof is definitely on the naysayers.
He says no evidence, but there's not no evidence, because inflation has actually ticked up several times in the past few months. It was at 2.4%, I think, in April, and now it sits at 2.7%. Also, it's worth noting that he's saying that we've been doing tariffs since January, which is technically true, but a lot of the big tariffs are continuing to get delayed and delayed and delayed, with the China tariff specifically having been delayed another 90 days just a few days ago. So he's not entirely correct, and mainly what the Fed says that they're concerned about is these large 145% tariffs that Trump keeps threatening, but then keeps delaying by another 90 days.
Oh, that's exactly what you say, and on top of it, the market is absolutely jumping at the moment, but do you get in here at these elevated prices?
It depends on where you get in. The burden of proof is that we have to show us the money. I mean, the economy, the market has to show us the money. Get over the finish line with respect to trade. Show us that inflation's moderating. Above all, show us that the job market can hold in there. So at 23 some odd times earnings, markets have pulled forward a lot of good performance. And so I expect a consolidation of these gains, but I do think there are pockets of the market that are still extraordinarily cheap and investable.
Such as, what are you guiding your high net worth clients and even your regular clients in?
Well, first of all, deregulation, we don't even talk about that. And that's the next big catalyst here. Deregulation will help the banks and brokers. It'll help the energy complex. Let's start with the financials.
I look at them today. We can put up both the big and the small ones. I mean, right now, I just quickly checked some of the bigger names and the medium-sized integrated money center banks, and they are popping here. I mean, anywhere from 3 to 4%.
The thing that I kind of don't like about how she's phrasing that is, should people get in now while the market's high? And the answer to that is always yes. You should always be investing. Even if the stock market goes down, every time it has ever gone down, it has always recovered. No matter what happens or what kind of economy we're in, unless you don't have a job, you should always be investing between 10 and 20% of your income every month over the course of 30 to 40 years. And in doing so, you will almost certainly set yourself up to have an adequate amount of money when you retire. Do not, under any condition, try and time the market. Something like 98% of day traders either lose money while trying to time the market, or they underperform just the S&P 500 in general. So do not do this. Always be investing every month, no matter what the economy looks like.
As they should. Because when you have a rate-friendly environment, which we're going to enter into, their net interest margins are going to explode. Then you get deregulation where they can loosen their purse strings and use their balance sheet. You'll see a huge jump in capital market activity. Then if you look to the energy complex, we don't even talk about the deregulation there. When you don't have the same onerous permitting process, you could drill, baby, drill. That creates more jobs. It brings energy costs down. It allows us not to be beholden to our enemies for energy. And those stocks are at 10-year low multiples.
And this is why I support the government investing in nuclear energy. It's very cheap, it's very safe, and it takes reliance away from Russia and Middle Eastern companies that we simply don't want to be reliant on. Energy prices are so volatile because OPEC sets the prices. But if we get away from that and are able to create our own sustainable energy sources, then that would be absolutely amazing. I understand drill, baby, drill to create our own oil here, but there are a lot more complications with that than people realize. And so I think nuclear is really the easiest and most straightforward, clean way of creating energy that we can use over and over.
Relative to their history.
Well, it's true. I mean, one of the worst performing sectors of the S&P this year is energy. Okay, so that is not overbought, I would say. I like that. When you look at the financials, maybe the bigger ones are overbought. Which part of the financial spectrum do you recommend people getting into?
Well, you talked about the Russell before, up over 2% today. Who benefits the most? Small companies that are most dependent on lower interest rates, because these are mostly domestic companies that borrow a lot. What about the smaller banks and brokers, the regional banks in particular? The group hasn't been this cheap in many, many years.
I have to ask you about tech, because technology is the real driver over the past, let's call it now, 2.5, 3 years. Yesterday, we led with the story that the CEO of Intel, and Intel, by the way, has been jumping the past 48 hours, and today it's seeing another gain. It's very close to the top of the NASDAQ 100. Lip-Bu Tan, the CEO, came under fire by President Trump and some members of Congress saying, oh my gosh, he's investing in Chinese companies and he runs Intel, which does a lot of work with the U.S. government. So Intel was oversold in a way. Now it looks good because Lip-Bu Tan met with President Trump yesterday, and Trump said, you know what, in a week, we'll come back with, the recommendations there. But boy, he has a great gutsy stories, American citizen, but he came from Malaysia, built himself up. But those are individual stories. What about the broader Mag 7?
Yeah. Well, the easiest and the best way that I'm counseling clients to invest in the whole AI complex is look no further than that Mag 7.
Really?
Who do you think
Look no further than just the S&P 500. If you invest in the S&P 500, it's something like 38% is made up by the Mag 7 right now. So you don't have to worry about not being invested enough of those. In fact, it's better if you don't, on the off chance that something happens with technology. If you attempt to beat the market, I can almost guarantee you will lose.
controls the eyeballs through their devices and the websites? It's those companies. Who has the deepest pockets to do M&A activity or R&D? Who has the most compute power? So why try to find tomorrow's AI blue chip when you could actually look no further than today's AI blue chips? And that's the Mag 7. Stay invested there.
So you're looking at where the puck is. And again, Apple's such a big story. In fact, I believe a month to date up 10%. Now, that one was maybe a little oversold, so you wouldn't be buying at the very top. So we always try and give some perspective to our viewers in that regard, but you're liking the Mag 7.
I am.
Like in the whole stock market, always be investing in the entire stock market. It's called dollar cost averaging. Pick an amount of money that you can consistently afford to put it in over 30 or 40 years. Don't bother trying to beat the market. If you do so, you will both lose money and you will have wasted so much of your time. And I understand there are a lot of concerns people have saying that AI is a bubble, but even if it is, the Magnificent Seven all have insane earnings quarter over quarter, essentially record profits across the board. And that's with their AI divisions losing a lot of money. So even if AI hype does die down, those companies are still making untold amounts of money. So you really don't have to worry about them specifically collapsing. The one exception might be Nvidia, because if AI turns out to not be anything particularly useful, they will lose market valuation. And even though they're the biggest company right now, they're not the only one. There are 499 other companies who will grow to take the place of Nvidia should Nvidia pull an Enron and just vanish. Now, in response to this news, the stock market closed at a record high, indicating people are thinking that it could be smooth sailing ahead for rate cuts. I'll see you Friday.